All right, let's do it. Time for a deep dive. We've got an interesting one today. A company about to go public, and you've sent us a mountain of financial documents. So our mission,
Decode these numbers, right?
yeah, decode these numbers, make sense of them, help everyone understand this company's financial story, like before they even think about buying stock.
It's kind of like a sneak peek behind the curtain, you know? We're talking fundamental analysis, revenue, profitability, cash flow, all that good stuff.
The stuff that really matters, right?
Absolutely.
It's what smart investors focus on.
So first things first, the company's financial health. What's the snapshot look like?
Well, they've had some pretty solid revenue growth recently.
Yeah, we see that in the document.
But revenue's only part of the story, right?
Never the whole picture.
Exactly. We got to look deeper,
Yeah.
see how profitable they actually are beyond just the top line.
Right, dig into those numbers, and that's where EBITDA comes in.
EBITDA, PAT, all those lovely acronyms. Earnings before interest, taxes, depreciation, and amortization for those who don't speak finance.
Or PAT, plain old profit after tax, both crucial for assessing profitability.
Okay, so let's jump right in. The source material has the numbers.
All right, hit me with them.
First up, ROCE, return on capital employed. How well are they using their money to make more money?
ROCE, the efficiency metric. Love it.
Their ROCE is 15%. So what do you think? Good, bad?
15%. Well, it's not bad. To really judge it, we need to look at industry averages and the company's own history, see how it stacks up.
Makes sense.
But off the bat, it tells us they're at least somewhat efficient with their capital, not just burning through cash.
Okay, that's reassuring.
Okay.
Next up, ROE, return on equity. Big one for potential investors.
ROE, the shareholder's darling.
Shows how much profit they generate for every dollar invested.
Yeah.
Their ROE is currently 20%.
20%. Not too shabby. Again, context is key. Got to compare it to their peers and past performance. But on the surface, it looks pretty healthy. Means they're delivering decent returns for their shareholders.
All right, returns are looking decent. Now for the core operational profitability, EBITDA margin.
Yeah, this one tells us how much profit they're squeezing out of each dollar of revenue. The real nitty-gritty.
And their EBITDA margin is 25%. Yeah. So how are those margins looking?
25%, huh? Again, we'd want to see how that compares to their industry, but overall it seems like they're doing okay, generating a decent chunk of profit from their core business.
All right, so we've got a picture of their current health, but what about the future? This company's aiming big. They've shared some revenue growth projections.
Yes, the always exciting, sometimes terrifying world of projection.
Right, they're projecting 20% revenue growth year over year for the next 3 years. Sound realistic? Or are they reaching for the stars?
20% a year for 3 years. That's certainly ambitious, no doubt about it. Those projections are likely to be a big selling point for their IPO, but we need to scrutinize those assumptions, dig into how they got to those numbers.
Yeah, because those projections are based on assumptions, like a perfect world.
Exactly. Things rarely go perfectly according to plan, so we've got to consider their past performance. See if they've been able to hit targets in the past.
Track record matters.
Absolutely. And we got to factor in overall market trends, what's happening in their industry. Is the market growing, shrinking? Are there any potential roadblocks they might hit?
Right, like new competition, changing consumer tastes, a million things.
Exactly. A million things that could throw those projections off course. So yeah, while the numbers look enticing, we got to stay grounded and realistic.
Okay, so revenue and profitability, checked. Time to talk about cash flow, the lifeblood of any business. We're talking free cash flow and cash from operations.
Real deal, right?
The real deal. Shows us whether they actually have cash to fuel growth, pay dividends, or just weather any storms.
Exactly. Positive cash flow, it's a beautiful thing. Means they're generating more cash than they're spending. Gives them options, flexibility.
Yeah, freedom to maneuver. But negative cash flow.
Ooh, that's a red flag. Could mean they're struggling to manage their finances, might need to raise more capital just to stay afloat.
Not a good situation to be in, especially for a company about to go public. So what does their cash flow statement tell us?
Give me the numbers. Let's see what we're working with.
All right, their free cash flow for the last year was $10 million. And their cash from operations, $15 million.
$10 million in free cash flow, $15 million from operations. Well, those are positive numbers. That's a good sign.
Definitely a good sign.
Suggests they're generating healthy cash flow from their core business, enough to cover their current operations and potentially invest in future growth without relying too heavily on external financing.
Right, so they're not just borrowing money to make those numbers look good.
Exactly. It's real cash coming in from their operations. Now, another thing to look at is their cash reserves. How much are they sitting on?
Yeah, their cash stockpile.
That's their safety net, especially in uncertain times. Gives them a cushion to make strategic moves, handle unexpected expenses. Of course, too much idle cash can also be a concern. But we'd need more info, their specific cash balance, to assess that.
Right, too much cash sitting around doing nothing can be a sign of missed opportunities.
Exactly. Gotta strike that balance.
Okay, time to face the D word, debt. Specifically, their debt-to-equity ratio. How much are they relying on borrowed money? Their current ratio is 0.5. So are they playing it safe or living on the edge?
0.5. Well, that's not terribly high, which is a good thing, but it all depends, right?
On what?
On their industry, their growth stage, their overall risk appetite. A high debt-to-equity ratio could mean they're aggressive, confident in their ability to generate enough cash to cover their debt payments. But it could also be risky, especially if things take a downturn.
High risk, high reward kind of thing.
Exactly.
Yeah.
So we'd need to compare this ratio to industry averages, see what's considered normal in their sector.
And consider their overall risk profile. Are they risk takers or more cautious? All right, from debt to valuation. We want to know if this company's stock is going to be a steal or a ripoff. We've got those key ratios to help us figure that out. First up, the price-to-sales ratio.
The classic price to sales, a good starting point, compares their market value to their annual revenue.
Simple, but effective.
Yeah, especially useful when you're comparing companies within the same industry, seeing how they stack up. But gotta remember, it doesn't consider profitability, only sales.
Right, so a company with amazing sales but terrible profits could still have a great price-to-sales ratio.
Exactly, it can be misleading. Gotta look beyond the surface.
Okay, next up, EV to EBITDA, enterprise value to EBITDA.
This one's a bit more comprehensive.
Includes debt in the equation,
Exactly. It gives us a fuller picture of their valuation, especially if they're carrying a lot of debt.
which some companies do.
Oh yeah, especially in certain industries. So EV to EBITDA helps us see how the market is valuing them, not just based on earnings, but also taking their debt into account. Smart. And finally, we've got PAT to cash from operations. Profit after tax compared to the actual cash generated from their core operations.
The cash conversion metric.
Helps us see if they're actually turning those profits into cold, hard cash.
Exactly. Because
Yeah.
sometimes profits can be a bit,
Fuzzy.
yeah, fuzzy is a good word. Accounting rules can sometimes make profits look better on paper than they are in reality.
Right, so this ratio helps us cut through the noise, see how efficiently they're turning those profits into actual cash flow.
A high ratio, good sign, means they're converting profits into cash effectively. A low one, could be some red flags there.
Okay, on to operational efficiency. Time to see how well this company runs its ship.
Let's get into the nitty-gritty.
Starting with trends in trade receivables, basically unpaid customer invoices. What's happening with their receivables?
Trade receivables, the double-edged sword, they represent future cash flow. That's the good part. But if they start piling up, that could mean trouble.
Trouble like what?
Trouble collecting payments could be a sign that customers are struggling or that the company's credit policies are too lax.
Either way, not a good sign for their cash flow.
Nope, not at all. So we want to see those receivables being collected efficiently, not ballooning out of control.
Okay, and then there's asset turnover. How effectively are they using their assets to generate sales?
Efficiency, efficiency, efficiency.
Are they getting the most bang for their buck?
Exactly. A higher asset turnover usually means they're running a tight ship, squeezing every bit of value out of their investments in property, equipment, and all that.
So what's their asset turnover ratio?
Lay it on me.
It's currently 1.2. Good. Bad. Average.
Again, got to compare it to their industry and their own past performance. But overall, it's not a terrible number. Means they're generating $1.20 in sales for every dollar of assets they own.
Not bad.
Could be better, but it's not a cause for alarm just yet.
Okay, last but not least, got to talk about third-party transactions. These are deals they have with outside companies.
Ah, yes. The sometimes mysterious, sometimes risky world of third-party transactions.
Right. And these deals can be complex.
Oh, absolutely. But understanding them is super important, especially in the context of an IPO.
Because those transactions can have a big impact on a company's performance.
Big impact on their financials, their strategy, everything. So we got to ask, are these deals beneficial? Or are they potential red flags?
Do they raise any concerns? Or are they opportunities? We'll dig deeper into that in the next part of our deep dive.
Can't wait. Those third-party transactions, they always keep things interesting. All right, back for more. Let's unpack these third-party transactions. Remember, these are deals the company has with outside companies. Could be good, could be bad, but look closely.
Yeah, kind of like opening a mystery box.
Yeah.
But in this case, understanding these deals, it's key to evaluating the company before their IPO. So where do we even start with these things?
Well, we got to figure out what these transactions are, right? What's the nature of these deals? Are they tied to their core operations, like manufacturing or distribution, or are they more strategic, like partnerships or acquisitions, joint ventures maybe?
So the type of transaction tells us about their strategy, sticking to their knitting or branching out.
Exactly. And once we know the type of deal, we got to look at who they're doing business with. Who are these third parties? Are they big, reputable companies or smaller, less established players?
That's huge. This is where things can get tricky, though, right? These third-party transactions, they can sometimes muddy the waters, especially if they're super complex.
Oh, yeah. Complexity can be a breeding ground for problems. And if these transactions involve related parties, that's another layer of scrutiny we need.
Related parties, what do you mean?
Basically, deals with companies or individuals that have a close relationship with the company. Could be family members, executives, things like that.
So we need to be extra careful there. Make sure these deals are above board, benefiting the company, not just lining someone's pockets.
Exactly. Transparency is key. And speaking of transparency, let's not forget about the terms of these agreements. What are the details?
Yeah, are the terms clear, fair, beneficial to the company, or are there hidden clauses? Potential conflicts of interest we need to be aware of.
Excellent point. We got to watch out for red flags, like transactions with related parties that aren't done at arm's length, or agreements that lack clear performance metrics. No accountability. Think of us as financial detectives, always on the lookout for suspicious activity.
Love that. So let's put on our detective hats and dive into these details. The source material, it lays it all out. Names, types of agreements, financial figures, the whole 9 yards.
Okay, let's start by mapping out the key transactions. Who's involved? What's the purpose of each deal? What are the financial terms? We'll create a blueprint of this third-party ecosystem.
I like that, a blueprint. We can even make a chart, just to organize all this info. And as we go through each transaction, we got to keep those critical questions in mind. What's the rationale for this deal? Is it truly in the company's best interest? Are there any red flags waiting at us?
A systematic approach, a healthy dose of skepticism. That's our recipe for success here. That's how we cut through the complexities and get to the truth.
Truth time. All right, the first transaction mentioned in the source material, it involves a software licensing agreement with a company called Tech Solutions, Inc. Seems pretty straightforward, right?
On the surface, yeah. But let's dig a little deeper. Tech Solutions, they're a relatively small player in the software industry, not a household name by any means.
Okay, so maybe not a big name, but what about the agreement itself? What's the company getting out of this deal?
Well, according to the agreement, they're licensing some proprietary software from Tech Solutions, software that's supposed to enhance their data analytics capabilities.
Yeah.
The deal is worth $5 million per year for the next 5 years. So a pretty significant chunk of change.
$5 million a year, that's not insignificant. But does this software actually deliver what it promises? I mean, have they done their due diligence, tested it out, made sure it integrates with their existing systems?
That's a great question, and one we don't have a clear answer to from the documents provided. There's some mention of a pilot program, but no detailed results or performance data. So yeah, a little bit of a red flag there. We'd want to see more evidence that this software is worth the investment. Another thing that caught my eye is the CEO of Tech Solutions. He sits on the board of our company.
Whoa, hold on. The CEO of the company they're licensing software from is on their board. Talk about a potential conflict of interest.
Exactly. That raises some serious questions about the terms of this deal. Was it negotiated at arm's length? Or did the CEO use his position to swing things in Tech Solutions' favor? We need more information here.
Big time. Okay, so the software deal, it's definitely got some question marks. We need to keep an eye on that one. What's next on our list?
All right, moving on. We've got a joint venture with global distribution partners. Now, this one's a little more complex.
Joint venture. So they're teaming up with another company to achieve a specific goal. What's the goal here?
Global expansion. They're basically partnering with global distribution partners to tap into new markets, specifically in Asia. The idea is to leverage global distribution's existing network and expertise in the region.
Smart move if it works. Asia is a huge market with tons of potential, but joint ventures can be tricky, right? Sharing control, aligning interests, all that.
Absolutely. It's like a marriage. Got to make sure both partners are compatible, committed, and have a shared vision for the future. Otherwise, things can fall apart pretty quickly.
And what about the financials of this joint venture? How's it structured? Who's contributing what? What are the profit-sharing arrangements?
Okay, so the joint venture will be structured as a separate legal entity. They'll each contribute capital, our company's putting in. $20 million up front, and global distribution is matching that. Profits will be split 50-50.
Seems pretty straightforward so far. But what about control? Who's calling the shots?
That's where things get a bit murky. The management structure, it's a bit complex. Each company will have representation on the board, but the day-to-day operations will be handled by a team of executives from both companies. So, yeah, lots of potential for disagreements and power struggles.
Sounds like a recipe for headaches. We need to dig deeper into the specifics of this management structure, see how decisions will be made, how conflicts will be resolved. Any red flags on that front?
Well, the biggest concern is the lack of a clear leader. It's unclear who has the final say in key decisions. Could lead to gridlock, slow down decision-making, and ultimately harm the venture's success. That's something we'd want to flag for sure.
Okay, so this joint venture, big potential upside if they can make it work, but also some potential pitfalls. Definitely need to keep a close eye on this one as well.
Absolutely. Joint ventures, they require careful planning and execution, not for the faint of heart.
All right, we've analyzed two pretty significant transactions, one software licensing deal, one joint venture, both with some potential red flags. What else do we have?
Okay, the last one on our list is a series of smaller distribution agreements with various regional partners.
Distribution agreements. So these are deals to get their products into new markets. Makes sense, especially if they're aiming for global expansion.
Exactly. These agreements cover different regions, Europe, Latin America, a few others. They're basically partnering with local distributors who already have established networks in these markets.
Smart strategy, leveraging existing infrastructure rather than building it from scratch. But with so many different partners, how do they ensure consistency, quality control, branding?
That's the challenge with these types of agreements. Lots of moving parts, lots of potential for things to go wrong. They need to have strong contracts in place, clear performance metrics, and a solid system for monitoring and managing these relationships.
Sounds like a lot of work. But if they can pull it off, these distribution agreements could really fuel their growth.
No doubt about it. But it's not going to be easy.
Yeah.
Got to stay organized, proactive, and on top of things. Otherwise, those distribution agreements could turn into a logistical nightmare.
Well, we've covered a lot of ground today. Software licensing, joint ventures, distribution agreements. It's clear that these third-party transactions, they're a major part of this company's strategy.
Absolutely. They're not just side deals. They're core to their growth plans.
But as we've seen, there are also some potential risks involved. Conflicts of interest, unclear terms, management challenges, logistical hurdles.
Right. It's a mixed bag. Potential for growth, but also potential for headaches.
So the big question is, do these transactions make the company a riskier investment? Or do the potential rewards outweigh the risks? We'll tackle that in the final part of our deep dive. Okay, final act of our deep dive. We've been through a lot, right?
We have revenue, profitability, cash flow, debt, those tricky third-party transactions.
It's been a journey, but now we got to bring it all together, right? See the big picture.
Exactly. What does it all mean? Time for the executive summary.
So, rewind. Let's recap. The company, impressive revenue growth.
But, yeah, their profitability, it's a mixed bag. Remember those metrics, ROCE, EBITDA margin? We talked about those.
We did it.
Those be super important to watch as the company grows, especially with competition heating up.
Right. Competition's always a factor. And those revenue growth projections, 20% year over year. Think they can pull it off?
Well, projections, they're tricky, right? Always based on assumptions. The world rarely plays out exactly as planned.
Never does.
So we got to consider their history. You know, have they hit targets in the past? And then the market, their industry. Is it booming? Is it stagnant? Are there headwinds they might face? Got to factor all that in.
So many factors, bro.
Tons of factors. But, I mean, that's what makes it exciting, right? Trying to predict the future.
That's why we do what we do.
Yeah.
Okay, and cash flow. Super important, even with great revenue growth.
Cash flow is everything. If they can't generate cash, it's all for nothing. Got to make sure they can cover their operations, fund growth, all that good stuff.
And their debt levels. Seemed okay, manageable.
Yeah, for now. But leverage, it's a double-edged sword. Can amplify returns, but also amplify losses if things go south. So definitely something to keep an eye on. That debt-to-equity ratio, make sure it stays healthy.
And speaking of healthy, valuation. We talked about those ratios, right? Price to sales, EV to EBITDA.
Oh, yeah. Those ratios, they're tools, you know? They can give us a sense of whether the company is priced fairly, but
But there's always more to the story.
always. Valuation, it's not just plugging numbers into a formula. Market sentiment, industry trends, all that plays a role.
The human element.
Exactly. Never forget the human element.
We also dug into operational efficiency. How well they manage those receivables. How efficiently they use their assets to generate sales.
Efficiency matters, right. The more efficient, the more profitable they can be. And they can gain an edge over their competitors.
Right, a competitive advantage. And then there were those third-party transactions. Deals with outside companies. Could be growth drivers, but also potential headaches.
Transparency is key with those. Always got to dig into those details. Make sure those deals make sense for the company, that there aren't any shady things going on.
Right, no hidden agendas. So after all this analysis, after looking at all these numbers, the big question, is this company a good investment?
That is the million-dollar question, isn't it, Tim? There's no easy answer. There never is in finance. Investing always involves risk. Got to weigh the potential rewards against the risks. Do your own research. See if it aligns with your goals, your risk tolerance.
Exactly. We're not giving financial advice here, just providing the tools and insights.
Arming you with knowledge. That's our goal.
But before we sign off, got to leave our listeners with something to think about, right?
Always. This company, they're in a fast-growing market, lots of potential, but it's competitive out there. So what are those factors beyond the numbers that might determine their success or failure? Things we haven't even touched on.
Good question. Brand reputation, maybe. Customer loyalty. How innovative they are.
All that and more. The ability to adapt, to change with the market, the quality of their leadership, their company culture.
Right. Numbers are important, but they don't tell the whole story. Got to look at the bigger picture, the qualitative factors.
Exactly. Do your research, stay informed, and never stop learning.
Couldn't have said it better myself. Thanks for joining us for this deep dive. Hope you found it insightful.
And maybe even a little bit fun.
Until next time, happy investing, everyone.